It's not the sweep that traps you, it's what you do in the next 3 candles. Most traders see liquidity get swept, get excited, and jump in immediately, thinking the sweep itself is the signal. It's not. The sweep is just the bait. If you're entering right there, you're walking straight into the trap you think you're avoiding. There's a specific sequence that separates a real reversal from a trap that's about to run you over. Most people skip straight from "sweep happened" to "let me buy this," and that's exactly where accounts get wrecked. Here's the sequence that actually keeps you out of the trap. Let me break it down. Part 2. The Framework. Rule 1. Weekly Candle Context. Before you touch anything on a lower time frame, you need to know where price sits relative to the weekly candle's high and low. This tells you which side of the range is likely to get raided and which side is the actual draw on liquidity. One-line rule: the weekly candle tells you the direction you're allowed to trade. Rule 2. Liquidity Sweep. This is the part everyone jumps on too early. A sweep just means price took out an obvious high or low, stops, breakout orders, resting liquidity. On its own, it means nothing yet. One-line rule: a sweep is bait, not a signal. Rule 3. CISD. Change in state of delivery. This is the confirmation. After the sweep, you want to see the short-term delivery actually shift, price closing back through the level it just swept through, showing intent has flipped. This is where most traders get it wrong. They buy the sweep itself, not the shift after it. One-line rule: CISD is your permission to enter, not the sweep. Here's the recap. Weekly candle gives direction. Liquidity sweep gives the setup. CISD gives permission. Let me show you exactly how this looks on the chart. Part 3. Live Chart Walkthrough. Proof. Okay, so first thing I'm doing is marking out the weekly high and the weekly low. This is our range for context. Price has been trading below the weekly high, so our draw on liquidity is actually up here at the highs. Now watch this low over here. Price comes down, sweeps below it, you can see the wick poke through, taking out all that resting liquidity. This is exactly where most people would have jumped in long already. Don't. We haven't gotten permission yet. So price sweeps the low and now we wait. We're watching for that CISD. We need a shift in delivery. And here it is. Price closes back above this short-term structure, showing us the intent has flipped from bearish to bullish. That's our confirmation. That's our entry trigger. Entry is right around this close. Stop loss goes just below the sweep wick, below the low that got taken. Target is the opposite side liquidity, which in this case is sitting up at the weekly high we marked earlier. Now let's look at a second example so you can see this isn't a one-off. Same thing here. Weekly range established. Price sweeps the high this time, we wait, and again, CISD confirms the shift down. Entry after the close, stop above the sweep, target down at the weekly low. Same sequence, same 3 steps, different direction. That's the model. Part 4. Callback and CTA. So that entry wasn't random. It followed the sequence. Weekly candle gave us direction. The sweep gave us the setup. CISD gave us permission to actually pull the trigger. That's why the sweep alone was never the trap. Trading it without waiting for the shift was. If you want to stop manually hunting for these 3 conditions every single day, I built a tool that marks the weekly range, flags the sweep, and highlights the CISD confirmation for you in real time. Links below if you want to check it out. And if you want to see how this same model applies to picking your targets properly, the next video breaks that down step by step. Go watch that next.